Coming up in today's episode, a huge wave of selling in the stock market could start tomorrow. Tesla's Q2 deliveries due out this weekend. Nike misses profit expectations. Fidelity jumps on the Bitcoin ETF train. Buffett loads up on more Occidental Petroleum. And Virgin Galactic takes its first customers to the edge of space. Hey, what's up guys? It's Jared here. Welcome back to Click Capital. And once again, we're seeing that bifurcation in the market, this time with mega cap tech selling off and the rest of the market having a nice little update here, especially the financials with that strong economic data. And oil's still got a bid there. Industrials are still holding up, and the defensive stuff along with utilities is still coming off a little bit. And again, more bifurcation in economic data. Helping out most stocks in the market today were those initial jobless claims. Coming in a bit lower than expected. We're expecting 265,000 claims, actually came in at 239,000. And then we also got Q1 GDP growth rate revised upwards a bit higher than expected to 2%. So far this year, the economy is holding up a little bit better than expected. And it should come as no surprise that Fed fund futures are now given an 86% probability the Fed will hike when they meet on July 26. And we've even got a 24% chance that they'll hike again when they meet in September. And unless something really surprising happens between now and July 26, it should be almost a certainty that Jay Powell does go ahead with the hike. He has been talking a bit of a hawkish tone lately, and with this latest economic data, inflation still well above target. The market can easily swallow another hike here. And that data today is further bumped up the curve in the Fed fund futures. We actually had the December contract finding 5.44 today, applied Fed fund rate by the end of the year, and that's quickly approaching highs we saw just before Silicon Valley, which was 560 on that contract. So far the economy is doing pretty well in the face of aggressive Fed rate hikes and after a banking crisis a few months ago. And I guess that all stems from the jobs market. As long as most people have a job, they'll still have money to spend and keep the economy propped up. So I'll be really looking at those unemployment numbers we get on the first Friday of every month as a key economic data point for me going forward to see what the Fed is likely to do. And as long as we've got high inflation and a tight jobs market, they should just keep on hiking rates until something does eventually break. However, we could be about to see some significant selling in the stock market tomorrow and possibly early next week as well, as tomorrow is the last day of the month, quarter, and first half of the year. A lot of fund managers have mandates to rebalance by then or at that date, or they want to update their portfolios just in time for their client reports to go out. And a lot of big portfolios do their balancing based on the yield differential between stocks and bonds. And so this is a 3-month chart of the government bond 2-year yield. We can see for this quarter, it's actually increased 20%. We started at 409, currently we're at 486, so that's gone up quite a bit, increasing the yield on bonds and making them more attractive. Then if we look at a 3-month chart of the SP 500, that's actually gone up 7% this quarter. And what that does is decrease the earnings yield available. And we can see that on this chart here, which is the SP 500 earnings yield minus the 2-year Treasury bond yield. So a way you could think of stock earnings yield is by expressing the price to earnings ratio as a percentage. And so for example, if the PE was 21, what you could do is 100 divided by 21, and that gives you a 4.76. So any stock or index with a PE of 21, that would be equivalent to a 4.76 earnings yield. And currently the S&P 500 earnings yield minus the 2-year Treasury bond yield is a negative 0.71%. And so we can see in the last month that's dropped quite a bit. It's not only the lowest it's been in a year, it's also the lowest it's been this entire bull market we've had since the GFC bottom back in early 2009. So what that means is big investors can get a higher return in the safety of Treasury bond yields versus taking more risk in the more volatile stock market, which is offering a lower earnings yield at current prices. And don't forget, corporate earnings have been contracting for the last 2 quarters as well. Not only that, but American stocks are trading at historically high valuations, especially compared to the rest of the developed world. And this chart here is 12-month forward PE, ranges over a 20-year timeline, with the bottom being the 10th percentile and the top being the 90th percentile. And you can see America is right at the top of its valuation range at 19.4. And this is contrasting the rest of the developed world with their current valuations a bit lower off those top end of the ranges, and on an absolute basis as well, much lower. And we can see that in a monthly spread chart of the S&P 500 versus the developed stock index. And what a huge outperformance it's been since that 2009 bottom, where the spread went from 2 to where it currently sits at 6. So in that time, American stocks have outperformed the rest of the world by 230% at current prices. So in other words, there's a lot more value to be found out there in other asset classes around the world and in bonds as opposed to American stocks when looking at an earnings yield, especially in comparison to the risk-free rate of bonds. So here we are on a weekly chart of the S&P 500. We just put in a bearish 7 count, and the NASDAQ is a bit more stretched as well in these technically overbought levels. So just looking at the daily SPY chart, we can see the market has ticked up a bit again today, but on weaker volume, and we have these strong bearish divergences on our dynamic swing index, the DSI, and our hidden divergence indicator as well. And that's pretty much the same story on the NASDAQ. We've got bearish divergences, and the hidden divergence indicator is in negative territory, along with the Dow, mid caps, and Russell. So tomorrow, the last day of the month, the last day of the quarter, the last day of the first half of the year, we could indeed see some selling from large portfolios, doing some rebalancing out of stocks and into higher paying bonds. And so going into all of that, we may see a bit of action in the options market, which has been pretty quiet this week on low trading volumes, but we've still got a lot of people loading up on calls. Even today, 58% of the volume was in calls. And all that call buying is what's keeping the fear and greed index stuck in the extreme greed zone here, really high at 80. And speaking of options, I wanted to introduce you to one of my latest custom indicators on the TradingView platform. That's Option IV Fair Value. And this is designed primarily for option traders. However, non-option traders can also use it to gauge volatility in any asset. And what it gives is a number that changes over time, and that's expressed as a percentage of what each stock or any asset should move as an annualized percentage. So on Microsoft, the indicator is currently got 26.2%. And what you'll find is the options market is quite efficient. Most of the time, option pricing will be around that number. And just looking in my brokerage account here at Microsoft Options. So you want to use the indicator value as kind of like a baseline to start at and measure that against the most near dated monthly regularly option expiries at the money. So we can see the indicator saying fair value is at 26%, but we're looking at the next regular monthly expiry, which is the third Friday of every month, and Microsoft at the money options are currently selling for around 21.5% implied volatility. Now let's quickly look at another example, Tesla. So the option IV fair value indicators got that a bit higher at 43%, as obviously Tesla's a lot more volatile than Microsoft. However, one thing the indicator can't see is upcoming events that can affect the pricing of implied volatility in options. And for example, at the end of every quarter, Tesla reports its latest quarterly deliveries of cars, and that can cause a bit of volatility in the stock price. So option dealers price that in by increasing the IV of options. And we can see that here in the Tesla option chain, with the July 21 at the money options selling for around 61% implied volatility. However, the indices don't have that news problems. They do have things like economic data, which can affect applied volatility and any big events the market's expecting. However, you'll find most of the time the option market is pretty well priced compared to what our indicator says that implied volatility should be. So for example, here on the Qs, it's currently got fair value for implied volatility at 16.44, and that's pretty much exactly what it is here right now, just a little bit higher at 17%. So when you're trading options, ideally if you're buying options, you want to buy IV when it's cheaper than fair value, and you want to sell options when it's a lot more expensive than fair value. And typically the further out of the money you go on puts, the higher the IV is. And the way you can think of delta, for example, here we've got a 0.2 delta on 352 strike. Another way to think of delta is that's a percentage probability the options market thinks that will hit there. So a delta of 0.2, the options market saying there's a 20% chance we'll hit that by that expiry. Another one of my most newest indicators I wanted to introduce you to is Momentum Scalper, and this is primarily designed for day traders, although it can be used on any time frame. And it's our own unique algorithm to show you when the market is moving really quick on hot momentum and volume. And it's primarily designed for the 1 minute chart or below. So this is a 1 minute chart of Nvidia. And when you've got this indicator, you want to set up real-time alerts for it to play a sound when it triggers, because it will trigger mid-bar and just let you know that the price of whatever you're interested in is moving really quick. There's a bit of momentum. So the idea is to hop on board, and that momentum is expected to continue for a little bit longer, and hence the name Momentum Scalper. And you can even use that on a 30-second chart, 15-second chart, and even all the way down to a 5-second chart. It'll let you know when price is moving really quick in one direction. And again, it can be used on any time frame. Here's Nvidia on the daily chart, and you can see it gave multiple buy signals, showing the market did have a lot of momentum back at the start of the year and things were moving up very quickly, but now the latest signal is a sell one, indicating momentum may have stalled up here. And here's a look with the indicator on the daily time frame of Tesla. We can see it's just got a sell signal recently as well. And so if you're interested in getting lifetime access to Momentum Scalper, Option IV, Fair Value, and all 20 of my custom indicators for TradingView that I've developed over the last 9 years, then head on over to our website, clickcapital.io/deal, and you can get all 20 of my custom indicators for TradingView for the one-time price of $197. And that comes with a 7-day money-back guarantee if you change your mind. And that also includes all future access to any new indicators I come out with, and I do have some very cool stuff in the pipeline. As TradingView allows you to import a wide array of data now, allowing to create some truly unique custom indicators. So if you don't want to keep using the same basic free stuff like MACDs and like everybody else is using, and you want to use some cool custom indicators, then head on over to this page and you'll get 50% off my indicators with no ongoing costs. And this deal is only available for the next 3 days, and I probably won't ever sell my indicators for this cheap again, as I've put in hundreds of hours over many years developing them. So I highly recommend you take advantage of this deal. And just getting back into today's news, so Wall Street's expecting Tesla to come through with 445,000 deliveries for Q2, which I expect they'll hit as well. We've got total global app downloads continue to trend higher, which is normally a good indicator for increasing sales. Data out of China for Tesla sales has been good recently. Customers did respond favorably to those price cuts we got earlier this year. First quarter deliveries did come in slightly below consensus, and so we'll be seeing what they come out with this weekend or early next week. And just looking at the stock price of Tesla, much like the indices, we've got these strong bearish divergences forming on our indicators. And we do have some bearish seasonality coming up in the next 10 days. Historically speaking, over the last 10 years, this next 10-day period, Tesla stock price on average falls 3.88%. Went up today on low volume. And so if they do miss on deliveries, we may see a big down day in Tesla next week. Nike came out with earnings today and missed expectations. Actually came off quite a bit. They reported fourth quarter net income 66 cents a share, which is actually down from 90 cents a share the same quarter last year. And just looking at the chart of Nike, we are selling off after hours down 4.2%. And after BlackRock filed an application with the SEC to open the first spot Bitcoin ETF 2 weeks ago, we've seen a flurry of other applications from other players in the industry, with Fidelity being the latest. And so with all these big companies lodging their applications with the SEC, I'd say they know it's going to go through. And that should be fundamentally supportive of the price of Bitcoin. And so while it was technically overbought the last week, you've been hearing me say, I think we could still break out from this level, because typically in trading, a good price doesn't last for long. And if you've seen the price hover at the same level for a while, that's typically not a good price. So I've got a feeling these reversal signals could fail here. We do have some bullish seasonality coming in to the market, and I've got a feeling this weekend we may break out above this 31,000 level, this big resistance zone on Bitcoin, as it's got that fundamental tailwind of all the biggest investment houses getting into Bitcoin with the new ETFs. And as I predicted, Warren Buffett has been buying the dip on Occidental Petroleum. He bought another 2.1 million shares in recent days, lifting their stake to over 25%. And you heard me say last Friday on my video, back here I predicted Warren Buffett would be buying more on the dip. We had this spinning doji on big volume. We got oversold on our DSI indicator, and our stock fair value and business quality score indicators like it a lot as well, saying the stock should be worth a lot more than what it is. And obviously Warren Buffett agrees as well, as he's really loading up the truck on this one. But in the short term, the price of OXY is highly correlated to the price of crude, and that's been holding up a little bit here, bouncing off this support zone, and is trading pretty flat, a bit soft on the downside, very similar to gold as well, just on this drifting soft wave lower. But we do have some bullish counts coming in, and I wouldn't be surprised to see gold back above 2,000 an ounce any week now. And 2021 meme favorite Virgin Galactic actually took their first customers to edge of space successfully on Thursday, kicking off the space tourism industry. However, investors weren't so excited about it, actually marking down the stock 10% on big volume. More signs dark pool traders are losing interest in the market at these levels. The DIX decreasing to 47% today. That's been diverging with the market a bit. Corporate insider sales ticked up yesterday and still exceeding purchases by more than 2-1. Back into the charts, and not a whole lot of exciting moves out there to report. International stock indices, really low volatility, much like the States. And we can see that in the VIX just trading so flat here at 13.5. Market is just not moving around. 2% down days and up days seem to be a thing of the past. And we can even see that in the realized volatility index, implying an annualized percentage of 10.35, and volatility risk premiums are very small, 3 points. Bonds are still moving around a lot more compared to stocks though, with the move VIX spread near all-time highs, and the price of out-of-the-money SPIX options increasing again with a skew at 143. There's breadth continuing to hold up well, 72% of stocks above their 20-day average. We now got almost 60% of stocks above their long-term average. And there's a look at the weekly chart of NYSE new highs, actually starting to creep up a little bit. We got 135 stocks making new highs today. Still nowhere near the last bull market, but does look to be showing some signs of improvement. And the NASDAQ, not as much, still pretty flat here. There's a look at the weekly chart of growth ETFs versus defensive ETFs. You can see we just put in a bearish 9 count above our buy-sell band, and is technically overbought as it's been for years, as we can see on the DSI. Similar story in the growth versus value spread. And there's a look at the weekly chart of the Russell versus SP500, just taking you down to a daily. Looks like it did find support where we're looking for it, and we've bounced back up above the 50 today. Bit of a risk-on move in the bond market, with the high yield versus treasury spread increasing to multi-week highs, and junk bonds versus investment grade ticking up as well. With that stronger economic data causing higher rates, that caused TLT to come off a bit. High yield bonds holding up a bit better. Stronger economy means a stronger currency, and we saw that in the dollar index today, sitting right at its 50, 103, and commodities still refusing to give up this big support zone, with agricultural commodities just losing their 50 and uranium trying to hold on to its one. Over to stock sectors, a lot of green across the board. The clean energy fund was the winner again today, up 2.1%. Then the losers today were the AI bots, semiconductors, ARC. Jets had a bit of a breather after a great run. Biotech continues to come off, and more weakness in the defensive stuff. We now got utilities back down to this support zone where we've bounced a couple of times this year already. We do have a little bit of a bullish divergence on the DSI, but the hidden divergence isn't confirming, so we're going to see whether this support zone holds here or not. A good gauge of the health of the US stock market is the price action in BlackRock, which continues to softly drift a little bit higher here. And look at that, pretty good move in JP Morgan, up 3.5% today on above average volume, approaching these multi-month highs where it's stalled out. And the more we come up against it, the weaker it gets. So I've got a feeling JP Morgan is going to break out here. And much like big energy stocks, the big bank stocks are still relatively undervalued as well. A stock fair value indicator's got JP Morgan at $319 a share. And I agree with that as well, because for the biggest bank in the world, I think a 400 billion market cap does seem a bit cheap, especially when we've got Apple right on the verge of 3 trillion. I think JP Morgan, being such a large dominant bank, way too big to fail, backstopped by the government, does deserve to trade at least fair value. So I think JP Morgan could have a bit of upside from here. There's a look at Nvidia on bearish divergences with bearish seasonality. Came off 0.72% today, just coiling up a bit here. Hasn't been below its 50 bar basically all year. Corporate insiders have sold about $200 million of stock ever since we popped up after earnings, and we'll see if whether this thing can break out above its all-time high around 440 again, or whether it's all said and done. There's Apple ticking up, finding new all-time highs again today. Just need to close above 191 for it to hit that big 3 trillion market cap for the first time ever. And the other mega cap techs continue to trade a bit weak. There's Microsoft, Amazon, Google, Meta, and Netflix all pulling back from their highs on these bearish divergences. Mixed day in the meme space, with Joby Aviation popping up 11% today. Bit of a pop in Big Bear AI. And I did a video late yesterday on the channel on 10 cheap AI stocks. And these are these ones here. They're all trading more than 30% below fair value according to our stock fair value indicator, and they all had a pretty good bump up here today. Disney got downgraded again today, and this has been an underperforming big large cap stock this year. However, we could be finding support here. We do have this big bullish divergence on the hidden divergence indicator, and just looking at our stock fair value indicator, it's got fair value at $129 a share, so we're currently 31% undervalued. And for the largest entertainment company in the world, some say the strongest brand, with the biggest library of content and cultural icons, maybe 162 billion market cap is pretty cheap for that. Of course, they have a few little short-term issues with things like bringing ESPN into the streaming world. We've had a few problems over the last year or two with management and leadership. Bob Iger's back at the helm and trying to turn things around and cut costs. And he does have a pretty good track record, so I definitely wouldn't bet against him down here. And overall, pretty good day for the regional banking space. With the prospects of higher rates, that's good for the banks as they increase their net margins, and we saw that with Charles Schwab breaking out to multi-month highs today. Okay, that wraps it up for today. Thanks very much for sticking with me. I continue to keep my personal swing trading portfolio around market neutral. In my opinion, at these levels, with a lot of contrasting data and price action, it's hard to tilt the portfolio strongly either way. We do have improving breadth in the market, but this is a level where the indices could have a short-term top and a bit of a pullback, especially with that rebalancing tomorrow and early next week, as these big funds may need to chew a couple of days worth of liquidity to get their portfolios back down to their target weights. However, as it stands, all movement and volatility has just been sucked out of the market, and I think we're going to have to get a real surprise to get things moving again. And finally, as a reminder, just head on over to clickcapital.io/deal and get our 20 custom indicators. Like I said, there's only a couple more days left on this special. All you need is a free TradingView account and you can start using all these indicators today. And thanks very much for all you guys that have purchased. I've been surprised by the amount of people that have been keen and eager to take advantage of this deal and get all these indicators. And I just want to welcome all you guys aboard. I look forward to bringing you even more new industry-leading custom indicators in the near future as part of this package. All right, guys, that's it. See you for the last day of the quarter tomorrow. Could be an interesting one. Cheers.